it's frowned upon, but hopefully that helps. So I don't know if we have another question ready or if it's okay. Dom's giving me the thumbs up. What do we have, Dom?
We have Marge and Tom called in with this one. If we get a reverse mortgage and decide to sell our house to downsize, is that going to be a possibility?
Hey, I think, Marge, you and I have been communicating via email too. So, this is a great question. And the reverse mortgage is, it's ironic that this question's right behind the last question when we're talking about equity as inflation buster. A reverse mortgage is the ultimate inflation buster because you're not going to have a mortgage payment anymore, and you're going to have that cash flow from the equity going into your pocket. So it's going to help offset expenses. But I really, really want to talk to you more about this. And I believe, Marge, that you and I have had some exchange via email. So let's continue that dialogue. But so to answer your question, if you sell the house to downsize, and if this is the Marge I'm thinking of, your concern was that you might need some assistance in the future and maybe going into an assisted living or downsizing and relocating closer to family so life is more convenient because, as I remember, you had a big house. But anyway, you just sell it. You sell it and the mortgage is paid off just like any other mortgage. You're not locked into it. I get it. It's a very unique. It's an uncommon program, so a lot of people are not comfortable with it. But you maintain ownership of your home. The mortgage company has a lien against your property. You can take your equity out in a variety of ways. You can take a lump sum payment at closing. You can get a credit line where you have access to the funds over time. It's an amazing program, but the best part is you never make a mortgage payment again. But yes, to answer your question, yes, you can sell the property and you just pay the loan off. There's no prepayment penalty. There's no hook, if you will. It's your house. You can do whatever you want with the property. You can leave it to your heirs, and then your heirs just satisfy the loan, just as if you were to pass away with a normal mortgage on your property. They would either sell the property and pay the loan off, and then the cash would go to the estate, or maybe one of the heirs wants to buy the property from the estate, and it's no different. Think of it just as a normal mortgage. The only strange part about it is that you do not make a mortgage payment. But yeah, let's dig in deeper on that. I'm going to call you because I know who you are, and we've exchanged a few questions throughout the week. So anyone else has a question, give us a shout, 561-291-8569. That's 561-291-8569, or visit the website, www.mr.mortgage. That's www.mr.mortgage. Hey, it's Mark Eitel, host of the Mr. Mortgage Show. You hear me all the time talking about the need to have the very best team representing you in a real estate transaction. And that starts with a really great agent. If you've got a great agent, that's awesome. But if you don't, check out www.reallyGreatAgents.com. There you'll find the best of the best, regardless of the city they work in or the brokerage they work for. www.reallyGreatAgents.com. www.reallyGreatAgents.com.
Here's another 5-star review.
We kept our business above water with credit cards during the pandemic. I'm glad we did. Business is better than ever. But I didn't want to be a slave to those credit card payments. I called Mark about the REC loan he advertises. Long story short, we did a REC refinance and paid off everything, even the car. Now we only have the mortgage payment. We're saving a bunch every month. Yes, we are happy to recommend Mark and the Mr. Mortgage team.
It's not every day that you need an appraisal, whether it's for a divorce settlement, estate planning, or maybe you're appealing a tax assessment, or you just want to make sure you have adequate coverage in your property insurance. When you need a certified appraisal, turn to my friends at SOFLappraisal.com. That's SOFLappraisal.com. Peter and his team have been appraising properties here in South Florida for decades. SOFLappraisal.com. And tell them you heard this on the Mr. Mortgage Show.
Are inflation and everyday expenses eating into your retirement income? Maybe you've considered a reverse mortgage and have unanswered questions like, do I still own my property? Can the bank kick me out? What happens when I die? Can I still leave my house to my kids? These are all great questions. Visit www.moreaboutreverse.com to learn more. That's www.moreaboutreverse.com. www.moreaboutreverse.com.
Welcome back to the Mr. Mortgage Show. Call us now, 561-291-8569.
All right, I am back. My name is Mark Eitel, host of the Mr. Mortgage Show. And you heard our announcer. 561-291-8569 is the anytime hotline. That's the best way to get questions to us. Dom is manning the board and the phone. Dom the Magnificent. He makes me sound good. I just need somebody to come in here and make me look good for the video segment of this operation we have running here. But yeah, anytime hotline 561-291-8569 or the website www.mr.mortgage. Again, never-ever-ever.com. Just type in mr.mortgage and we will magically appear. So last thing on Julio's question regarding the cash out for the rec loan. It got me thinking, and I knew I had this here in my notes in my show prep. I just didn't have my hand right on it during that question. So I found this super interesting. Americans have $856 billion in credit card debt based on this report, which was, I believe, the end of last year. So we have returned to our bad habits. We were all well-behaved during COVID when we were locked in our houses and we couldn't shop. And Amazon was slow to deliver, so we must not have even been shopping with them. But $856 billion with a B in credit card debt. One interesting thing is, though, CoreLogic, their report shows that the American households have $3.2 trillion in additional equity since the fourth quarter of 2020. So that's another 29.3% appreciation. So my point in that is, at the pace of appreciation, there's plenty of money in our homes to pay off our credit card debt. Not probably the way we intended on paying that credit card debt off, but you might want to grab some of that equity, knock down some of that credit card debt, and just behave yourselves with those credit cards from now on. So anyway, I want to keep the show rolling with questions. I just wanted to double back on that because those numbers, in addition to being mind-blowing with billions and trillions, I just found that interesting. So, hey, Dom, do we have another question?
We do. We have Matt that emailed us. He said, I read about a lock and shop approval online. What happens if I don't buy before the end of the lock of time? Do I get my money back?
Hey, that's a great question, Matt. I'm going to explain lock and shop first because I know there's a lot of people out there that have no idea what you or I are talking about right now. So, lock and shop is not something we've talked about until very recently, because over the last 2 years or so, rates have been falling. So tomorrow's rate was often better than today's, so there was no need for a lengthy lock. So what lock and shop does, it allows you to lock your interest rate now for an extended period of time. And lenders all have a different program for lock and shop. Some of them are 90 days. Some are 180 days. There's a few of them out there that will even let you lock for up to a year. Now, your reference to getting your money back, obviously, whatever website you were on, you mentioned you were online, there's a fee associated with that. Those are typically the extended, the 180s and the 365-day locks. Up to 90 days, some up to 120 days you can do without a fee. Almost always a 90-day lock and shop has no fee associated with it. So there would be no need for you to get your money back if you didn't execute on that rate lock by buying a property. Now, with the 365-day locks and the 180 locks where you pay that fee up front, most often that fee is gone. If you don't execute the lock by closing on the property, the lender keeps the fee. And think about it logically, right? So the lender is taking that chunk of money and committing it to you at a specific interest rate. So I know they have billions and billions of dollars to lend, but if you're borrowing $400,000, they've earmarked $400,000 to you, Matt, right? Yeah, Matt. They've earmarked that $400,000 to Matt, at today's interest rate of whatever it is, let's say 4.25%. Now, in 6 months, if interest rates are 5.25%, they still have that $400,000. Think about it like it's sitting on the shelf. It's what do you call that when you buy something at the store and you wait to go pick it up? Layaway. You've put that money on layaway. So if you don't execute that lock and close that property, that money's been sitting on the shelf. They could have, in that 6 months or in that year, probably have lent that $400,000 2 or 3 times. Because as everyone knows, most often, once your loan closes, it's not long after that before it's sold to a new servicer. So lenders are moving through that available capital line that they have to lend. So their goal is to lend that money, get you into a mortgage. They'll package that up and sell it on the secondary market. But if that $400,000 has been sitting there on layaway, like that shiny bicycle at Walmart, and every other kid is walking by saying, Mom, I want that bicycle. I want that bicycle. And the Walmart employee says, I'm sorry, that's Matt's bicycle. It's on layaway. There's a fee associated with that. That bicycle at Walmart, there's 6 or 8 other kids that would have loved to take that thing home. So I know that's kind of a weird example. It just jumped in my mind. And sometimes I think in pictures, but that's the best analogy I could come up with is you've reserved that money and you've paid a fee for that reservation, and you don't get it back if you don't use it. Now, I encourage you, let's have a conversation about some shorter term lock and shop strategies, because you can get a significant amount of time with no fee, and then there's no obligation for you to close the transaction. And we do that all the time. We'll get somebody pre-approved. We'll actually even go through underwriting. Your loan is fully underwritten, you're pre-approved, your rate is locked, and you're out there house hunting. Sometimes, thankfully not often, but sometimes you don't find a house. And I've got an instance that just popped to mind with a gentleman named Steven. Steven moved back to Colorado. His life plans changed. There was significant disruption in his life, and he's not here to buy a house anymore. And the Mr. Mortgage team isn't licensed yet in Colorado, so we don't do transactions there. So Stephen, there were no fees associated with that lock for Stephen, and he didn't. Anyway, long story. The answer to your question is, depending on the program, if you've paid a fee, you're most likely not going to get that fee back. And there are strategies to work around it. I would welcome the opportunity to talk with you, even if it's just a second opinion on something. 561-291-8569 is the anytime hotline. Again, that rings to my office during the week, 561-291-8569. Or visit the website, www.mr.mortgage. That's www.mr.mortgage. So I'm going to throw it back to Dom, see if we have time for another question.
We do. Real quick. This one's from Lisa. It's a text question. Lisa asks, my boyfriend and I are not married yet, but we want to buy a house now because everything is going up. Can we still use his VA loan?
Hey, that's a great question. So yes and no. Okay. Yes, you can purchase the property, the two of you together. He can use his VA entitlement, but you're not, as an unmarried couple, going to get a 100% loan because he's the veteran. He's entitled to the 100%. So most often with an unmarried co-borrower is what you're going to be classed as, is a down payment requirement of 12.5%. And again, there might be some variations on that. I'm happy to walk you through it. The good news is you still get the VA interest rate, which is always a better interest rate. There's no mortgage insurance associated with the VA loan, even though in this instance, you've only put 12.5% down. And it's a great program. So you can still utilize it, but anticipate having to put the down payment down. Now, if you guys are soon to get married and you're married, that changes things. But in the current situation, as you've asked the question, anticipate a 12.5% down payment because you would be classed as what we would call an unmarried co-borrower in the world of the VA loan. So certainly worth looking at. If you're going to buy that house together and he's got his full entitlement, that's a great option because with just 12.5% down and no mortgage insurance and a preferable interest rate with the VA loan, that's a great loan program if you're able to pull the trigger on that down payment. But any other questions on that, give us